You are listening to The Vocal Technologist. Spoken tech for your ears.
If you feel like the financial world is moving at just an insane speed right now, you are definitely not wrong.
Not at all. It's early 2026, and it's this remarkable period where you have these two realities basically colliding.
Right.
On one hand, you have the big traditional banks. They just closed out a record year.
Yeah.
Absolutely record-breaking.
Buoyed by the rate environment, of course.
Exactly. But on the other hand, you have these fintech compounders who are really consolidating their power. They are breathing right down the necks of the incumbents.
And they're not just building, a slicker app anymore. They're changing the actual infrastructure underneath it all.
That's the key.
And that's really our mission today. We want to cut through everything that's happening and highlight the foundational shifts being laid down as we speak.
Yeah.
You can think of this as a kind of Founder Fridays analysis. We're not looking at the flashy IPOs. We're looking at the strategic, sometimes hidden moves that are being made to lock in long-term dominance. You know, how startups are going from disruptors to actual regulated institutions.
And we have to frame this against the consumer reality. Because while we're talking about these massive profits and huge infrastructure builds, we can't forget this strange paradox happening in the West.
Which is?
High consumer spending, but against this backdrop of like a quiet, constant cost of living anxiety.
Financial nihilism, almost.
It is. People are spending, but they're incredibly stressed. And all the tech we're about to discuss, it has to survive inside that very anxious reality.
Okay, so let's unpack that first massive structural shift then, the quest for the bank charter. For years, the whole identity of fintech was being the disruptor, right? Fighting the establishment. So why are these high-flying giants all of a sudden desperate to trade in that revolutionary image for, the constraints and the red tape of a bank charter?
Well, because the biggest constraint on modern fintech isn't the technology anymore. It's regulated access. It's access to capital, to lending. The moment you decide you want to own the entire user experience, from the deposits all the way through to lending, you realize, oh, I need to be the bank.
Give me a concrete example. Who's doing this right now?
The perfect one is the business banking startup, Mercury. They've gone all in.
Okay.
They've applied for a national bank charter with both the OCC, the Office of the Comptroller of the Currency, and the FDIC.
Wow, that is a massive, massive undertaking. I mean, the time, the legal fees. What's the immediate payoff for taking on that kind of operational headache?
It all comes down to control and cost.
Right.
Right now, Mercury is basically a software layer.
Right. They sit on top of other banks.
Exactly. To hold customer money, to do all the regulated stuff, they have to partner with what are called sponsor banks.
And that relationship is expensive.
It's expensive, it slows down new product launches, and critically, it means Mercury doesn't fully control the user experience or the economics. Getting the charter just cuts out that middleman entirely.
So it's not just a sticker on the box that says we're trustworthy. It's about owning the actual engine of banking, which has always been lending.
That's it. A charter removes the single biggest barrier to them, offering really sophisticated lending products to their customers. It lets them get into that high-margin business. And this is clearly the big trend. I mean, we saw more than 30 companies file applications to become banks in the U.S. this past year alone.
30. That's an astonishing number. It really says a lot about the maturity of the industry. It's not about a better user interface anymore. It's about becoming the utility itself.
It is. And this whole chase for infrastructure is happening right alongside this other fascinating VC trend, which is sort of a private equity playbook.
The VC roll-up, you mean?
The VC roll-up, yeah. Instead of building from scratch, they're just acquiring smaller, traditional financial businesses.
Like what, an insurance broker or something?
A regional insurance brokerage, maybe a compliance firm, a specialized lender. They buy it, and then they instantly layer their own AI technology on top of it.
So they get the regulatory access and the efficiency gains almost overnight.
It's a much faster way to own those regulated rails, for sure.
Okay, speaking of owning rails, let's switch from the regulated infrastructure to the data infrastructure, because this is where things get really strategically interesting. I'm talking about the shift to agentic commerce. And if you're a regular listener to The Vocal Technologist, you know this is a theme we hit on a lot. We're moving way past simple voice commands into a world where AI agents just do the entire job for you.
And we finally have real-world proof points. Visa and the developer Aldar just announced the first live implementation of something they call Visa Intelligent Commerce.
And they define that as an end-to-end, voice-enabled agentic payment experience.
End-to-end is the phrase that matters there.
Right. The AI isn't just hearing you say, I need a flight. It is handling the negotiation, the price comparisons, filling in your details, and then actually executing the payment. All of it.
It's truly hands-free financial agency. But for an AI to do that, to transact on your behalf, it needs access to clean, structured, reliable product data.
Which is a huge mess right now.
A total mess. And that's why the move Klarna just made is, well, it's one of the smartest infrastructure plays of the year. They launched the Agentic Product Protocol.
That's their open standard for structuring product data. It sounds like a pure land grab for data supremacy.
It absolutely is. I mean, by offering this open standard, they're giving these new AI shopping agents access to just a staggering pool of data, over 100 million products, hundreds of millions of price points.
So Klarna is basically trying to build the map that all the conversational AI will use to navigate e-commerce.
That's the bet. They're positioning themselves so that when an AI agent goes shopping for you, it has to use Klarna's directory to, facilitate the action. It becomes the new search bar.
That's their moat. Wow. And I assume this move into machine speed commerce requires machine speed risk mitigation.
It has to. It's the other side of the AI coin.
Right.
A company called Informed IQ just raised $63 million for this exact thing. AI-powered fraud prevention and loan verification. Their agents can analyze billions of data points almost instantly to confirm borrower info.
So it's an arms race. The speed of commerce demands an equal speed of verification.
You need that countermeasure, yeah.
Now, if we kind of zoom out from this AI infrastructure war, there's a parallel shift happening with digital assets. The whole regulatory view has just fundamentally changed.
It's been an incredible journey, going from being labeled a systemic risk to just another market development.
What was the main signal for that change?
It was actually pretty quiet. The Financial Stability Oversight Council, or FSOC, they just removed digital assets from their list of systemic financial vulnerabilities in their 2025 annual report.
And that one kind of bureaucratic decision, that signals the end of the regulatory chokehold.
It's the official end, yeah.
Yeah.
It felt like a 3-year chokehold, so no more fear that, if some crypto platform fails, it's going to bring down the whole U.S. financial system.
Yeah. So they're just another market to watch now.
Precisely.
Yeah.
It just reflects the reality of what's happening. You have spot ETFs, you have tokenization projects, and most importantly, you have the rise of properly regulated stablecoins. The fear is just being replaced by pragmatic integration.
And nothing screams integration more than the arrival of SoFi USD.
Exactly. So SoFi launched the very first bank-issued stablecoin. It's issued by their FDIC-insured national bank, and it's one-to-one backed by actual cash held at the Federal Reserve.
So it's taking the speed of crypto and putting it inside the safety of the traditional banking vault.
It is. But it's not just a cute product for their retail customers. This is really an infrastructure play.
How so?
The main use for SoFi USD is faster, lower-cost settlement for businesses and for other banks. I mean, instead of a slow bank wire that takes hours and costs, $30, $40?
Right.
A regulated stablecoin can move $100,000 between two companies in a few seconds for pennies.
And they're offering this as a white-labeled service for other banks to use, too.
So the whole consensus view has flipped. Regulated stablecoins aren't a threat anymore. They're seen as a complement to banks.
Yeah.
They make the whole system more efficient.
It's the ultimate pragmatic adoption. If the tech is useful and it's properly regulated, the system will eventually just absorb it.
It always does.
Absolutely. So with this huge push for infrastructure charters, AI protocols, stablecoin rails, what does this mean for the actual products being built? Who's winning and who's losing right now?
Well, you're definitely seeing a big push-up market.
Okay.
The big compounders are trying to leverage their massive retail distribution to start serving high-net-worth clients. Revolut is making serious moves here. They're in early talks with Blackstone to make private market funds available on their platform.
Which follows that playbook we've seen from Trade Republic and Robinhood, right? You get a massive user base with a simple product, and then you use that distribution to sell them complex, high-margin products that used to be only for the ultra-wealthy.
Distribution is king. It always is. But then you look at a vertical like homeownership, mortgages. And the picture is way, way more brutal.
Okay, so you've got a success story with Monzo acquiring Habito, the digital mortgage broker.
Right. Monzo already had, what, 450,000 users in their home ownership feature in the app? So the acquisition just lets them plug in a full end-to-end mortgage experience. It's perfect synergy.
But then you contrast that with the shutdown of Mesa's homeowners card.
Yeah, a tough one. They raised $9.2 million and then just abruptly closed up shop.
And their whole model was giving you high credit card rewards for paying your mortgage.
A huge, very low margin payment. The economics just didn't work. It's a really harsh reminder that you can't just slap a rewards model onto any kind of payment, especially one as big and low margin as a mortgage.
The financial geometry, as you said, has to be flawless.
It does.
And speaking of winning geometry, what about on the B2B side? Specifically with accounting for small and medium businesses, AI seems to be completely changing the game there.
It's a powerful shift. We're seeing embedded AI native accounting that's built inside other software, like what a company called Layer is doing, and it can now fully replace a legacy system like QuickBooks for a lot of businesses.
Now, how is that possible? I mean, how do you replace decades of institutional knowledge baked into something as massive as QuickBooks?
You own the distribution and you own the transaction data.
Ah.
Think about a restaurant's point of sale system. That POS system is already capturing every sale, every payroll expense, every invoice. So by embedding the AI accounting right into that system, they just automate the bookkeeping from end to end.
So the tool the business uses to run its operations becomes its financial home. There's no need to export data or reconcile anything.
You bypass the old model completely.
That makes so much sense. Okay, before we wrap up, we have to go back to that human element we started with, that consumer anxiety, the financial nihilism, because a recent study highlighted a really serious consequence of making credit so easy to get.
We have to.
Oh.
A study from Johns Hopkins University found a very, very concerning correlation.
Oh.
Adults who reported symptoms of depression, anxiety, or PTSD were significantly more likely to be using buy now, pay later loans.
Wow. That is a chilling reminder that while we're here talking about these huge strategic moves, a big portion of the audience is just quietly battling serious financial stress. And the easier you make it to access debt, even small amounts, the more you can impair financial decision-making for people who are already vulnerable.
It's the essential ethical question, right? As these platforms become more and more powerful, their social responsibility has to rise at the same rate.
It does. Okay, so let's try to synthesize all of this. We've established fintechs are buying up regulated infrastructure, either with charters or that VC roll-up playbook.
Right.
AI is quickly becoming the autonomous operating system for all of commerce.
And regulators have basically normalized digital assets. They're not a vulnerability anymore, they're just a market to be developed.
The word of the day is consolidation. The ambition isn't just disruption anymore, it's about ultimate control of the entire financial stack.
That's the end game.
So here's the final thought I want to leave you with. The big banks just had a record year, but now the fintechs are getting their own bank charters. The power of the regulator is shifting. So if the biggest consumer platforms in the world eventually become banks themselves, and every piece of financial infrastructure, from stablecoins to data protocols, gets commoditized, what's the single most scarce commodity in finance 5 years from now? Is it still the capital? Or is it the customer trust that Mercury is trying to buy with that charter application?
A fascinating question to carry forward as you watch all these changes unfold.
That's all the time we have for this one. Thank you for exploring these massive structural shifts with us. We'll catch you next time.
Spoken Tech for your ears.